Welcome to the presentation of the results of the German Debt Project Report 2023. The real estate industry in Germany is navigating stormy waters, and so does the real estate finance industry necessarily. We have prepared a new report together with Simon Wiersma and me, and on the back of interviews, quantitative analysis and qualitative interviews. Thanks a lot to our sponsors, that is Bulwin Gesa, CREFC, Greenberg Traurig, Indreal, MSCI and the TIA, and a special thank you to the VDP for providing data and access to partnering banks. As in previous years, we have led roughly 24 of structured interviews with banks, and we have analyzed their portfolios amounting to roughly 250 billion euro financing volume, and derived our analysis from there. The participating banks you see here, so it's a mix of big international and national banks and a small number of local banks, regional banks, savings banks, and this brings us to the conclusion that it is a comparatively good overview of what's happening in German real estate finance. Before I start to go into the details, let me summarize the main findings. First, transaction and financing have come down significantly since the first quarter of 2022. The average might be 20-30% of the peak, but some banks report a drop in volume of up to 60-70% of their overall financing volume. So the range of the recession is asymmetric in the banks, but all banks report that the overall business is going down. Second, banks are focusing a lot on cash flow and not so much on the debt level itself, not so much on LTV ratios, but cash is king. And that brings us also to the point that core assets are primarily attractive. Banks are focusing on core assets because they are hoping that these are those assets that are promising cash stability. The fourth aspect is the tremor in the real estate finance is not limited to the senior loans to the credit banks, but it's also going into the mezzanine, into the equity financing. So there is not only pressure on the banks, but also pressure on the non-banks lending. And this is something that is promising for the next quarters, additional pressure on the real estate market, because we don't know for this segment where the problems are, because transparency is bad in Germany, but it's significantly bad in the non-bank lending industry. And the last aspect is regulators on the back of this development have tightened their regulation and have made more on-site visits, have started to do their own valuation, have asked more data, have asked more information about also green aspects. And this leads to additional transaction costs for the banks, making financing more expensive. But what is more, some of these regulations seem to be even pro-cyclical. That means aggravating the downward pressure. Because they are starting to break into a breaking market. I will go back into these details later, but all banks were reporting that they feel significantly increase in regulatory pressure. Overall, the real estate markets have been burdened by the rising interest rates. This is nothing that started only on the back of rising interest rates, but is something that goes back at least 3 years when the pandemic started, because that led to significant increase of monetary policy, and that was the promise that sooner or later this has to go in reverse at one point. That is, going into reverse in such a significant strength is maybe only surprising for those who have not looked at the monetary impulse of the last previous years. But this sharp increase from a virtually zero inflation environment to a comparatively normal interest rate environment means significant pressure on those asset valuations that have been valued at a zero interest rate environment and have now to come back to normality again. What might be looked at as a bursting bubble is most likely not a bursting bubble, but simply a revaluation to a different interest rate environment. You see in this chart how different asset classes moved through this development. The hotel and retail industry was particularly affected during the pandemic. Office markets have also been negatively impacted by that and have not moved up since then, because the discussion on work from home is of course burdening that till the end. To understand this chart, keep in mind that the 100 index point level is the mark between growth or decline. So the only two sectors that are currently evaluated as positive is logistics and residential. These are two sectors where investors and financiers feel more at ease. But even for those, you can see they are flirting at the 100 index point level, significantly below the levels that we've seen before. So this is the investment environment, and it mirrors pretty much what is happening in the financial industry. Not surprisingly, then, the competition pressure on the bank side has been going down. So that means competition pressure is easing, which sounds like a nice thing, is of course reflecting that there is not so much willingness to finance. So these red bars in the previous years were indicating that there is a significant increase in competition. Margins were going down, banks were bidding till the last base point to get a deal. In the first quarter of the pandemics, this was already easing, but competition was so tight in the quarters thereafter that it came back to the high competitive pressure very quickly. And only in the last 4.5 years, we see that competition has been gradually easing again. That means some banks are withdrawing, other banks are focusing to some segments, and that leaves a lot of room, potential room, on those segments that are fighting for capital. We'll go back to that. Overall, for 2022, the portfolios we are asking were not showing a significant decrease in overall lending volume. The new business is declining, but not so much as might have been thought. This is particularly due to the very strong first quarter 2022. If we would have calculated that from the second quarter onwards, this would be a significant double-digit number. And this is what the sentiment, when you ask the banks also in the interviews, is mirrored. Namely that a double-digit decrease is reported, and this is continuing in 2023. So the overall decline in the overall new business for the banks is significant in the two-digit, maybe 20-30%, for some banks even up to 80%. The financing abroad is not a valve for that. That means there is not banks that are going more abroad than they did before to find new business. And of course, this is simply due to the fact that rising interest rate is not a German phenomenon, it's a European, it's a global phenomenon. So the pressure to finance in falling cap value markets is of course everywhere the same. It is stretching the bank's business, going anywhere. So therefore the mix of countries is surprisingly comparatively stable, and the overall lending abroad is stable too. So why did the overall book of the banks did not decrease further? This is particularly due to more developers are not paying back their debt fast enough. So the extraordinary repayments have been shrinking. And here in this chart you can see the value maybe of the German debt project particularly nicely, because it signals that this indicator, the repayments, and especially the extraordinary repayments, have not been declining only since the pandemic, but long before. The cyclical peak for the development was most likely reached long before the pandemic. So long before the overall volumes have been starting to decline, long before the interest rates movement, the best growth period where the quick euro was able to be made was already reached long before. Because of course developers are able to pay faster back their debt when they're able to sell the project before and faster than expected. So this gradual decline is indicating that the development wave has been starting to ease long before. As said before, what are the niche markets that are particularly eyed at is residential and logistics, like in the previous years. Who's the new laggard next to retail and hotel? It's office. Office has been eyed very differently in the previous years, but now that we know that work from home is likely here to stay, all the financing and the renegotiating of rental contract leads to banks being more conservative on lending also for office transaction. Who's winning? Well, offices that are located in the central of the city. And that comes maybe as a surprise. During the pandemic, there was much discussion on shall offices move to the fringes because people are able to work from home and the offices simply follow where the people now stay. However, banks and investors are eyeing the locations in the city center and not so much in the vicinity, at the periphery. So why is that? Because office changes its way we do it. It's not so much a way of doing your daily work, going into Excel, going into Word, going into SPSS, but it's about getting connected to other people. So the reachability to getting to the office is key, because then it's possible to bring all the people quick as possible from the different locations in a city, and that is then best possible in the central locations of a city. And that is understood by investors and financial institutions, and therefore they are eyeing particularly those. What is more, these are the properties that are comparatively high quality and have a comparatively high ESG standard, because they are expensive and therefore the refurbishment is comparatively valuable, comparatively easy, because the refurbishment costs or the certification costs are distributed on a big amount of investment capital. So all these aspects benefit rather the central than the peripheral offices. And you see also that in retail there are some niches that are shimmering, that are already starting to grow. It's not all retail that is burdened. What is typically the case during a recession is that investors and financial institutions focus on core. What is then observed very often is that investors like to have smaller buildings, smaller tickets, because they want to diversify, going into quick deals, not investing all their capital. What's happening now is a little bit the opposite. So the share of the particularly big tickets has been growing in 2022. That might be a surprise, given what I just said. In a typical recession, this is the segment that loses. However, this recession also means that investors like core and like the inner city and like to have something that is ESG compliant. And that is comparatively often the bigger tickets. What is more, what I just explained is that the peripheral locations have been even more burdened. So the gain of the central location is a relative shift from the even more losing peripheral to the less losing in the inner city. And that is explaining why we have this strong shift in lot sizes in commercial. So which cities are particularly attractive? Well, as in previous years, it's the A cities. Honestly, this mirrors also our portfolio that we analyzed. So it's big banks. So big banks are going to liquid markets, and that is particularly the A cities, namely Berlin, Frankfurt, Munich, Hamburg, Cologne, Düsseldorf, and Stuttgart. But this share is stable. It is not going up and it's not going down. So the banks keep their strategy intact. So other good news looking ahead? Yeah, there are some good news. And the one good news is that the burden on material costs seems to be easing. That was particularly during the start of the Ukraine war that the delivery chains have been deteriorating, have been burdened, and that construction has been burdened by rising energy prices, material prices, and this seems to be going much better today. However, this is good news with some problem. Namely, the problem is that it is rather the lack of new developments, that means of new completions, of new demand, that is leading to less demand for these materials and bring down overall demand for materials. But at least those who are producing, those who are developing, have a significantly lower problem of getting the material that they need. This is not implying that we have zero problem environment, far not. The sharp increase of interest rate has particularly burdened small residential developers, those who have maybe one piece of land and one project under development. So we see a lot of developments that are pushed away, that are cancelled, that are not being done at all. And that is particularly true for residential, which is a problem because there is a high demand for residential new builds because we have scarcity on the back of strong inward migration. You see here a new survey from the IFO Institute. We have reached an all-time high in cancellations of new orders in residential. And what is more, what I've said about the material prices, this is not yet in the price indices. This is still on a very high level. So we are still some quarters away till the lower prices of our material can really bring some benefit for the developments. At the moment, we are still on a very high price level for all buildings. So how banks operating? They keep their leverage low. So the overall LTV keeps at the 60%, slightly below 60%, comparatively stable. That means with falling values, the levels of debt will also decline. Banks are reluctant to increase, otherwise the LTVs would go on. And this is of course also following the advice of the regulatory bodies and also their regulation. What is different than in the previous years is that the strategy of the banks with their LTVs have narrowed together. In 2020 it was much wider. There were some banks aggressively trying to get in the market, others banks being more reluctant. Now it seems all the banks are similarly reluctant. There are fewer players who would try to make benefit of this low competition. So it is a putative low competition environment because if there is no competition occurring, it doesn't really matter if it's low or high. So when overall prices are going down and LTV is stable, then of course loans come down. So we run some calculations. How far could prices go back? If they go back to 2018 levels or 2014 levels or even 2010 levels, you see that LTVs at current loan levels would explode. So that is the fear of the regulatory bodies, that they run most likely similar scenarios. How far would prices need to go till we reach an unsustainable level of debt in the market? And this is not requiring going all the way down to 2010. It is not necessarily the case going back all the way to 2014. You see that even for going back only to 2018 would imply a significant problem, especially in the residential financing market. So can mezzanine lending close this financing gap? Well, on paper, of course, yes, but only on paper. Because the mezzanine lenders were also showing a complete range of different actors. Some will have a long track record, some have a lot of equity, some have expertise in the market, and some are comparatively new. So this means that also in the mezzanine lending there will be some selection occurring, some winners and some losers. The winners will be able to benefit from significantly higher interest rates and lower competition, and the losers will simply drop out of the market. So there is a second line of risk occurring in the near future, namely that from the mezzanine lending side, a new restructuring necessity is showing up for the lending market, for the equity side, or in case the equity is burned and mezzanine is also not able to close the gap, then more pricing pressure on the properties and the land might occur. So where do margins go? Margins have started to go down after a sharp increase in the last year. But this is not so much because of the competition, but it's a change of the portfolio that is financed. Fewer developments and more core properties. So if you have more core properties and fewer developments, the average margin will go down because of course core properties have a lower margin than a development. So this is what's happening. So the decline of margins in the financing, both gross or net margins, is not indicating that there is negotiation strength of the investors, but it's rather signaling that the banks are reluctant to going into risky territory. And this is also here indicated that the situation that in 2022 there was still a large number of banks with different strategy is going to a smaller amount of strategic window. So they seem to be following similar strategies. With regards to extra fees, there's actually not so much new to be reported, pretty much the same story as before, comparatively stable. What is new in this German debt project was we talked in the interviews a lot of time about regulation. Many banks reported that the regulatory bodies have been tightening their regime, going deeper into the books, asking more questions, being more resistant to get the right answers, getting even into our own valuations and forcing to even devaluate. And what is more, ESG has been coming not only the new kid, it's one of the strongest kids on the block. So wherever we talk, we started with ESG regulation, we started with ESG portfolios and all that. And of course ESG is particularly E. It's not so much social or governance issues, but it is E. So where is environmental issues particularly important? For office and logistics. For office, of course, because I said it is primarily the top locations, the big investments where ESG compliancy can be dealt with easiest. What came as a surprise maybe is logistics, that ESG criteria play a significant amount of times for logistics too. This is stemming rather from the observation that logistics is new builds rather than existing buildings. Then of course for new builds it's much easier to be ESG compliant because you follow what is currently possible. And logistics have a market timing of maybe 20-30 years, so therefore it is easier to have a new build in logistics to be expected and financed than in office, retail or residential. So therefore the importance of ESG compliancy in logistics is stemming from financing new builds. Do banks expect that ESG is paying a different spread? Not so much. Banks are currently trying to keep the spreads between green and non-green financing pretty small. Some banks offer a little bit, but most banks do not. So it's a few base points difference between green and grey buildings. They expect that this might be going up, but primarily maybe on the back of expected regulation where the ECB might be offering a better equity position for green. But this is rather a bet on the future. There is no indication that this is around the corner. What was important when we talked about the regulatory issues, well, we have the national regulation coming from Berlin, for example, the GEG on energy and properties. And we have the Commission, European Commission regulation, for example, the taxonomy. And we have regulations stemming from the capital market supervisory, like ESB, BaFin or Bundesbank. So there was no clear picture which of these regulatory bodies was the tightest or the most important. It seems that every bank is struggling a little bit with similar but still individual problems with these regulatories. But this is not so much the issue here, because regulation was a part of the success story why we are not in deeper problems at the moment. I will come back to that. Regulation helped to prepare the banks to weather a new crisis. So therefore we call this navigating stormy territories, waters, and not being in. But it was enabling the banks to getting through this. However, not every regulation is similarly good and beneficial. For example, banks were reporting that the new regulation on capital buffers for anti-cyclical or for sectoral, namely residential, came not only as a bad timing but also for the wrong sector, because residential is so stable from the demand side, and the timing having it included not close to the peak when it's rising, but closely after the peak when it's already starting to fall, means that we are starting to make more higher burdens when the problem is actually already virulent. So in that sense, these two measures come too late and maybe for the wrong sector, because the problems seem to be bigger in commercial lending for office, retail and hotel, and not so much on residential. Of course, residential is the biggest chunk of all financing because the asset class is so big. But we have rather too few buildings than too many on residential. So therefore, we should rather build more. So making financing more difficult in this segment, of course, makes it even more difficult, preventing buildings to exist. So in that sense, this is not only counter-effective, but it's also most likely pro-cyclically making the problem worse. The rising inflation was one part why this market peaked and came into reverse. So what do banks expect for inflation? Pretty much the same as the overall economic consensus does. Namely that inflation will gradually go down, but will still remain significantly above the sustainable or quantitatively sustainable level of 2% even for 2025. Does that already lead, this semi-recessionary scenario, lead to a rise in NPLs of non-performing loans? Well, it does and it does not. It does for commercial real estate. We see a tripling of non-performing loans value from the lowest point up to the latest observable point. However, this peak of that we've reached is still only 1/3 of what we've reached in 2010. So you can see this for commercial lending with a positive and a negative eye. Either you say, okay, it's going up, and this is already signaling that there is a recession, or you say it's still far below what we had in the last recession. What is more, for residential, it is still flat as a piece of paper. So that means NPL for residential is still very, very low. So two important messages here. Regulation helped that this is the case. So we have made the refinancing environment more stable. But current regulation looking on sectoral capital buffers is actually looking at the wrong segment. It seems that commercial is more at risk than residential. So we're asking the wrong deals to have more equity in the lending than actually seem to be the vulnerability of the market. Looking ahead, what risks and opportunities do the banks see? Well, the risks are clear. Are we getting rid of inflation? Will we keep an interest rate environment? Is there a geopolitical risk? And what is new, climate risk was the first that we ever differentiated between transitory, that means regulatory, and real physical, that means real weather event driven risks. So banks start to look at these risks in a pretty academic way, how we do that also in climate risk models. Interestingly, different from last year's, the opportunities were not very well positioned. When we asked them what are the opportunities in the market, in the last years there was always like real opportunities that are deviating from just the lack of risk. This year, as you can see from this list, the majority of the opportunities is actually, well, maybe if we are lucky, the risks do not materialize. That is not really an opportunity, that's just a lack of risk. So therefore, it is signaling that risks still prevail. Banks are very hesitant to see opportunities, carefully managing and navigating the market. So in that sense, they are navigating the water, but it is still stormy and therefore they act prudently. If you want to buy the complete study of approximately 100 pages, you can go to our IREBS Immobilienakademie store and buy the complete study. The study was prepared by Simon Wiersma and myself in course of this summer, so all data is pretty much current level where we had the interviews over the summer and the data cutoff for the quantitative analysis was end 2022. So thank you very much and hope to see you soon.